Hello everyone, how's it going? So in this video, we're going to do a quick update on Mullen. Well, I meant to say as quick as possible, of course, because every time they are first-time viewers, so it's better to recap to a certain degree what happened so far. So Mullen's recent performance has been disappointing. There's no way around it. The sell-off, in my opinion, has been at least continuing on putting its pressure. And at this point, I would say that the reasons why this company is doing poorly in the financial market is due to company specific reasons. They seem to matter more than the economic trends and what's going on within the industry. So, what we're seeing from other EV companies is that their prices is not doing that bad, comparatively speaking. So, this is why I would say that it's Mullen that has to prove its own relevance and its own reason of being, if you will, to the market within this new environment, which is more challenging than back in 2020 and 2021, of course. So far, it's trying to tell investors that they will be a successful, EV company, but time might be running out for the company as far as the patience of investors go. Um, Recently, they bought Bollinger, probably Bollinger, and they've issued a statement. Basically, they have enough money to support this purchase, and everything is going to be great. On the other hand, it seems like websites like Investor Place have put Mullen as one of the possible EV companies that can disappear just a few years from now. Their arguments are as follow. If we think about it, the EV battery that Mullen is known for has been tested by a company that doesn't have like the best of the credentials or the track record, and their partner that has been making the batteries for them went out of business recently. So none of these is really good news for the company, and I would say that it also throws a layer of doubt on a question of whether the company has any sort of substantial thing beneath its logo. So this is a real question that we can ask, and it's actually relevant if you want to hold this company for the medium to long term. And to some extent, the short term as well, because obviously, if everybody thinks that this is a joke, then its price will not do well. So they've also announced that they will not have an EV rolled out until 2025. And if they say this, it simply means that they're not going to have a product within the foreseeable future. Because if they say that they won't have it before 3 years, they might have one in like 5, right? And by then, who knows how the sector is going to be. This is good and bad news. So it is certainly bad news for people who want to believe in the company long term. But the good news is that until then, the speculation could be strong. And it doesn't really matter if the company has good fundamentals or has, anything substantial. We have to remember that a lot of companies have been able to surf the speculation tide, and a lot of traders have done well as long as you're completely sober about the reality that this company doesn't have a real product. A lot of its parts are either outsourced or evaluated by people who may not have all the credentials to evaluate them. But as long as you can speculate how much the speculation will be in the future, this is going to be a good opportunity still to make money. It doesn't mean that it's going to create a lot of jobs. It doesn't mean that it's going to make like wonderful EV cars. I'm just saying the volatility is the bread and butter for traders, right? And in this case, we know that the downward pressure has been immense on this company. So just based on these, I think that it's good enough for me, at least, to say that if you are the kind of person who likes to jump from one volcano to another, then that might be a decent option to think about. Another thing is that its CEO, David Mitchery, had multiple failed ventures. Now, this, in my opinion, cannot be such a strong argument because a lot of investors or a lot of market stakeholders, they wouldn't mind investing into people who have failed multiple times before. I mean, for example, the founder of or the co-founder of Apple, Steve Jobs, has failed multiple times in creating companies that are, viable and sustainable before coming up with excellent ideas towards the end of his career with Apple, right? So I wouldn't put this as such a red flag, but we need to keep in mind that sometimes there are failed companies and there are failed scams, if you will. So companies mean it's companies that are like they are real. The investments are real. The intention was real. It just didn't pan out. So that is option number one. Option number two, it was never the intention to make a business. It was just the intention to absorb money from investors with new PowerPoint slides. So, from the wording of this article, in my opinion, they're saying that David Mitchery actually belongs to the latter. So, this is their opinion. I think that there needs to be some nuance in this assessment. But of course, this company is a small cap. It's riskier than most. It's even riskier than most growth companies. So this is why we should keep this in mind as we go forward. But it doesn't mean that you cannot dance with that company. This is simply not true. So my view, like I said before, is that it's possible that this company may not be on the up and up on every single aspect. And it's currently very easy to say that things are bad when they are currently bad, right? It's not even the benefit of a hindsight, it's the benefit of the current reality. So right now, it's a game about speculation on speculation. Do you believe that given the price action of Mullen now, it's going to have a bounce back mechanically because there are so many people offloading their shares at the moment? So if you don't think that this is going to happen, then maybe don't buy this stock. But if you think that mechanically things are going to bounce back, just because at some point people have to, how can I put this? People have to give the shorts or give their unloading a break, then maybe you can have some short-term plays with Mullen. And it may turn out better than what a lot of people give them credit for. Now, there are also some like chit-chats around the market that this company might go through some kind of short squeeze. Now, there are some indications that a lot of shares need to be redeemed very soon. So this is one thing, but on the other hand, it's only 15% according to Fintel. So I would say that there will be a certain pressure to redeem their shares, but at the same time, I wouldn't say that this would be a massive factor of a bouncing back. I don't think that this is going to be the main element. Its purchase currently seems incapable of lifting the stock price on its own either, but the keyword is currently. So for now, we're sure that it cannot do miracle work for Mullen, but it's possible that within the next few years, this purchase would be proven like strategic, right? For now, we don't know. Let's just say that they've spent a bunch of money to buy a company. Let's see if it pans out. It's irrelevant, in my opinion, for the short term because the market doesn't seem to have taken notice. So if you want a contrarian position or a marginal position for possible moonshots, then Mullen at the current price point might be one of the choices. With that being said, this is obviously a contrarian position, meaning according to the crowd wisdom, it's a stupid idea. But you have to remember that when no one is watching, this is maybe the time to start watching. When no one is interested to buy stuff, this might be the time to start buying stuff, right? Who was seriously thinking of buying real estate back in 2009, 2010? No one. Do you want to buy like AIG shares in 2009? Immediately, like just a few days after they were announced to almost go bankrupt, right? But that stock 5 to 6 years later would have 10x'd. But no one would be thinking like that. Or when the crypto coins fell earlier this year, back in June or something, my first reaction was, okay, this might be a good time to start, coming back in, because buy low, sell high, the low doesn't happen all the time. And we just have to ride out the short-term volatility. And for that, we simply have to buy in batches and not in one shot to make this happen. So there are ways to work around those, but I would say that keep your eyes peeled about good opportunities to snipe some of those good deals. This is valid for the short term, medium term, and the long term. But in my opinion, as far as Mullen is concerned, we're talking about a time frame of a few months, probably not a few years. I'm sorry for people who have faith in this company long term, but in my humble opinion, I wouldn't bet my house on the fact that Mullen would still exist 5 years from now. Okay, 5 years is a long time for penny stocks and stocks that are trading OTC. And it's also a bit of a long period of time to consider for any stock that's like in the NASDAQ. So this is why I would say that Mullen has its relevance, but just not in the long term. Long term, they have to show that they can fundamentally turn things around. And so far, they haven't shown any shred of indication that they can, right? They might come out with like good presentations, how wonderful their batteries are, some CGI composition of a car demo, but I think that we are past that age. And at the moment, the short term would depend on like pure speculation and the amount of money coming in and out of the industry. For the medium and the long, the company does have to come up with strong fundamentals, or at least reasons for us to believe that the fundamentals would be better in the near future. So I would say that if your portfolio is sufficiently diversified, maybe consider to get in like 1 to 3% of your portfolio's capital into Mullen. I would say maybe stick to 1 unless you're very risk-taking. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth-type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.